over again that you can identify with mathematical formulas or with these visual price patterns. But the problem is that there's no mathematical formula that can get into the mind of the individual traders who actually are driving prices up or offering them lower. But if you don't know that, you somehow or another, if you're trading on a smaller time frame, and you get a little pullback right here, okay? And based on that pullback, your methodology says, okay, it's time to buy. And you do. And you do it just before this hedge fund manager comes in and starts driving the price up. See, you're going to think that the reason why you won is because that your mathematical formula told you what was happening next. And that was the reason why it happened. What I'm saying to you now is that there almost isn't any reason that you could come up with, whether you won or lost, that would correspond to what really happened in the market. Do you hear what I just said? There's almost no reason that you will come up with to put on a trade that will ever correspond with the actual reason why the market went up or the market went down, other than the fact that there was an imbalance in conviction between buyers and sellers. Because the people who do this will not tell you unless it's in their best interest to do so. And the reason the people who report it in the news agencies, they don't know either. They're making it up. They make up the reasons because they sound reasonable. They are paid to sound reasonable. And there's no way to verify what it is that they say.
Or to disprove what they say.
That's right. There's no way. The only people who can do it are the people who actually made the trades. The only people who know for sure what's going to happen next are the ones who are willing to make it happen. And see, we'll put on a trade and find ourselves in a nice monster little winner here and think, oh man, my methodology, it is just fantastic. And then the next time you get the same signal and then you don't get anything. Not only that, it's a loser. You think, oh, now you feel betrayed. You think your methodology let you down. Your methodology wasn't designed to tell you what's going to happen next on a trade-by-trade basis. No technical methodology is. That's where your expectations are not in line with the reality of the situation. That's why it's so easy to make mistakes. It's because you're expecting something from your methodology that just doesn't exist. It just doesn't. It never did. On a trade-by-trade basis. They will tell you what will happen. Let's say, I don't want to use the words to happen next. They'll tell you what will happen over a series of trades on a percentage basis. This particular pattern will emerge X number of times, and when it does, there's a higher probability of this happening than that. If I limit my risk when I take the trade, and my profit potential is at least 1 or 2 or 3 times greater than what I need to risk, then over a series of trades, I will be a consistent winner. That's what trading is all about, guys, as a passive technical trader. Unless you're doing this other stuff, I just said it right then and there. I said it all right then and there. There was a guy that came to me for consultations several years ago. He was he wasn't really anything. He was a guy that he was a guy that lost a lot of people's money. Is basically what he was. He was a really good analyst, I should say. He was an excellent analyst. In fact, as far as market analysis was concerned, he was probably one of the best analysts I'd ever worked with. But the problem is that he had some really, as far as executing his trades, and let's put it this way, he was, let's say, on the arrogant side. That's being nice. And so when he put on a trade, he just thought that was it. The market was going to do what he thought it was going to do, period. So he was the kind of guy who, he went through all of his relatives' money with trading accounts and his friends and that sort of thing. And he was getting to the point where he was really exasperated. So he came to me for consultations. And basically after listening to him, I said, hey, you know what? Why don't you do something, get paid for something that you're good at, and, and stop trying to, stop losing other people's money and go get a job as an analyst. Just get paid to be an analyst, not as a trader. And so he did. He got a job with one of the major clearing firms at the Chicago Board of Trade. as one of their analysts for their brokers and that sort of thing. And the president, or actually the chairman of the board, his son was actually the president. Chairman had retired. He was an old-time grain trader, soybean trader, and made his money in the 40s and the 50s and that sort of thing, and traded pit-style trading. In other words, something that I talked about early this morning. I'm not going to get into, but in any case, he didn't make direction-related trades, and so he was really mystified with the idea of technical analysis. I mean, he really was. He was literally mystified with the idea that you could basically predict prices based on chart patterns and that sort of thing. So he thought, well, you know what? I'm going to sit down with this guy and this star analyst here that we have in the firm now and find out what this crap is all about. Basically, is the way he thought about it. And so he's sitting down with him for a few days. And it got to a point where one day the soybean market was basically trading in a range, about the middle of a range between what the analysts projected as the high of the day, not just the high of the day and the low of the day. Okay. And so the market drifted around, maybe did a little bit of close to a test of the high. And it's coming down to the low, and they're both sitting there and they're both watching it right now. And the chairman of the board, the soybean trader, old soybean trader, says, "Okay, so this is going to be the low of the day right here, right?" The guy said, "Yep, that's it. Gets that price, it's the low of the day, low of the day." And the guy looked at him and he said, "That's bull." And he picked up the phone, which had a direct line to the soybean pit. He said, "Sell 10 million beans at the market." Now, 10 million beans is 2,000 contracts because they trade in 5,000 bushel increments. So he hit the market at that moment with 2,000 sell orders, okay, which immediately drove the price down 10 cents, which basically is $1 million trade, by the way. Driving the price. Of course, if he'd have sold all of them at this price and bought them all back at this price, but there was an average price down. But from here to here is $1 million on 2,000 contracts. And then after the price dropped, he looked at him and said, "Hey, if I can do that, anybody can do that. If I can do that, anybody can do it." Now think about the implications of what I just said. If you remember back in that survey that we just took a little while ago when I said it only takes one trader somewhere in the world to negate the positive outcome of your edge? Oh, gee, what if you were one of the people that bought right here? How many people did it take to mess up your trade? Just one. Just one person. That's all. It's usually more than one, but that's all it takes is one. You guys starting to get the idea? This kind of stuff is going on all of the time. As a matter of fact, when prices move, this is usually the reason why. When I was at Merrill Lynch, and for many years, even when I was teaching, material in the psychology of trading, I didn't really include a lot of this stuff because I just sort of took it for granted that people understood it and knew it. And the reason why I took it for granted is because I guess I learned it so early in my trading career that it just, it was self-evident to me. But it was self-evident because here I was at Merrill Lynch and I had access to a squawk box. Now, our squawk boxes were open phone lines to the various pits in both Chicago and New York, meaning we had Merrill Lynch representatives in each of those pits that as buy and sell orders would come in, they would tell us who was buying and who was selling. What houses, what manufacturers, what big accounts, what big traders, if they could. In other words, if they had access to the information, they would tell us who was buying, and maybe who was even taking the other side of their orders if they could determine it. So it's like you had a very intimate. It was like you had this sort of intimate connection with what was really going on. Now, at the same time, when I was doing my own technical analysis, I would do my equations because we didn't have computers back then. Of course, you could do the Hewlett-Packard, the handheld thing, but I didn't do that. I did all my equations all my analysis on a spreadsheet, and I actually did all the calculations by hand. And I did it on purpose that way so that I could get an intimate sense of how the actual mathematics of my signals, in other words, the actual calculations, the multiplications, the divisions, the subtractions, and what the final product was in terms of a signal, how it related to the actual market movement. And I found that there was no relationship, other than the fact that it would identify patterns where the signals would work sometimes and sometimes they wouldn't. But the point is that there wasn't any relationship between this fixed mathematical formula and the people who were buying and selling at that moment and the reasons why they were doing it. There was none at all. But not only that, here's what really shocked me, is we had a TV monitors going all the time. And we had it on, in Chicago, there was a local investment channel, Channel 26. And it was very much like CNBC now, but it was a lot less sophisticated. And, so we'd watch as people would come on the show and with various, have various interviews and that sort of thing. And I'm watching one morning, and there's this vice president from Heinhold, which now doesn't exist anymore, but they were one of the biggest hog and meat producers in the Midwest back in the 80s. And this vice president from Heinhold is being interviewed by the guy on Channel 26, and he's talking about how people got to get into live hogs and pork bellies because prices are going up, and and he's just going on and on about what a great investment it is, and really and this would happen quite frequently, by the way, but this was just an example, and all the phones started lighting up. These are all the people in the Chicago area, the typical, the traders in the Chicago area that are listening to this guy, because when I say that, because the phones are lighting up and all the brokers are starting to take orders to buy bellies and buy hogs. And I was thinking, well, that was pretty impactful, right? Oh, gee, then on Squawk Box, guess who's taking the other side of those orders? Heinhold. They needed somebody to come in and take the other side of their orders. What does a mathematical formula have to do with that? Now, as it just so happens, if my math is working in a way where I happen to get in at that moment and I end up in a winning trade, well, that's great. But that doesn't mean I can rely on it to do the same thing the next time. Okay, I explained hedging, reverse auction. In a normal auction, this is what I'm talking about dynamic traders right now. In a normal auction, what do people do in a normal auction? In other words, if you're in a situation where things or items are up for bid, when you're outbidding somebody, what are you doing? You're eliminating the competition, right? In other words, by bidding higher, you're hopefully eliminating anybody else who'll bid higher than you. Hedgers and commercials and dynamic traders create what I call a reverse auction. They'll bid a market up or offer it lower to try to attract the public into the market to take the other side of their trades. You guys with me on this? They will bid a market up or offer it lower as a reverse auction. That doesn't mean that they want the market can go higher, but their immediate objective is that if they're bidding it up, it means that they want to sell. They just want someone to take the other side of their trades. So they're actually creating a reverse auction, attracting people into the market, because as the market goes up, people are thinking, okay, I'm going to be missing out, and I've got the assurance that I need that it's going to keep on going, and so they get sucked into this move, and then they slam them with a huge order. Now, see, I had intimate contact with all of that in Merrill Lynch. I really, not only that, I mean, because I knew the floor traders, I knew many of the floor traders who actually created the movement that particular day. And there were a number of times where the movement was significant and they were fast markets and enough to attract the media to the exchange, and they put a microphone in front of their mouth, and they definitely would say something that was palatable to the public. In other words, what was reasonable. I can guarantee you that the reason why they did what they did during the day had nothing to do with what they said. Nothing. There was no relationship whatsoever. Go ahead.
I fully understand your concept of the movement that's taking place because of dynamic players. And I can understand how that would relate to the commodity, stock, and stock options market. But can you have the same effect in, say, the foreign currency market, where it's a much bigger market that's traded worldwide?
It just depends on the player. Absolutely, you get a central bank that starts unloading something, and then it's gonna have a major impact on the market. Yes, but you've got basically what you have is a situation where this market's so large, it's so liquid that it would be very difficult for individuals to have any impact on it. Is that what you're saying to me? Is that what you're?
Well, I wasn't necessarily limiting it to individuals. I mean, even a central bank. On the world market, could they have that kind of an impact?
Well, it's what I call the pebble in a pond effect. Okay, they might not have enough impact initially. Okay, initially to do something. Okay, to have that meaningful, to create that meaningful of a price move. But you've got a pebble in a pond, which is the way a lot of prices move anyway. Because it's like what you got is you drop a pebble in a pond. Well, if it's it creates waves, does it not? Okay. And what I found is that, especially with floor traders, and really the same kind of dynamics work even with off the floor traders in the general market itself. I found that what you had is that most floor traders did not know what they were doing, in the sense that they didn't have a real good reason for buying or selling at any given moment, other than the fact that they were following the lead of other people who they thought did have an idea of what they're doing. So what ends up happening is that what you've got the guy, the trader who's confident, knows exactly what he's doing, why he wants to do it, and does it. And then you got all the other guys who are, let's say, in the pit, okay, who are closest to this guy might be on this step right here, who are closest to this guy, that will mimic what he does. And then what it does is it starts spreading out. And that as word gets out, okay, the guys at the farthest end up getting prices that are greatly diminished in relationship to this particular individual. But the point is, it's kind of like the pebble in a pond. A central bank could create the same thing. In other words, initially, a central bank hitting the market with a huge order might be absorbed, but the fact that the central bank is doing it will cause other people to want to do it too, and therefore, as a result of all the other traders who pile on, it creates a huge move. Does that make sense? Okay, we're moving right along here. Okay, dynamic traders, okay, players, they know and understand the mindset and behavior patterns of the crowd or herd. They basically refer to the general public as the herd, and they are the herd masters. Okay, they are the herd masters. Whenever possible, they will use that knowledge to move prices in a way that will extract the most amount of money from the largest number of traders. That is their mission. That is what they do. Characteristics of passive technical traders, they're usually mystified by price movement. Would that be a fair characterization? Okay, they wouldn't think about trying to cause price movement. As a result, they typically can't conceive of anyone else doing it either. They're typically drawn into trades based on an opinion about the attractiveness of the price or stampeded out because of fear. The passive technical trader's objective is to find himself in a winning trade without any intent to move prices. Now think about what you're doing. You are trading in a way where you want to find yourself in a winning trade, but absolutely wouldn't even think about moving prices to do it. You're completely dependent on someone else doing it for you. To find himself in a winning trade, he's dependent on other traders to be willing to either buy or sell at a worse price than himself to create movement in his direction. The typical passive technical trader is expecting other dynamic traders to make him a winner when they usually have little or no knowledge, insight, or understanding about how dynamic traders operate. Would that be fair? The typical passive trader does not realize it only takes one dynamic trader somewhere in the world to negate the positive outcome of his edge. Is that a fair statement now? Does anybody want to argue with the statement anymore? And I'd say anybody did in the first place, but there are some people who raised their hand and said that wasn't the case. Is there anybody that's not convinced about this? Seriously, I want to know. And we're not going to get into a fight or anything, but you know. Okay, the characteristics of technical analysis. Now what we're going to do is we're going to take what we now understand about the nature of price movement and look at the nature of technical analysis to see, just see what we got here, okay? See how well it meshes. Okay, technical indicators define, identify, and organize market data, the up and down ticks into understandable patterns. Are you guys with me on this? The patterns are observable, quantifiable, meaning they can be measured, and repeat themselves with statistical reliability. And really, while I'm doing this and while we're going through this, I want you guys to really keep in mind that just because I explained the underlying characteristics of dynamic traders and people who can actually move the market and do it all the time. In fact, when the market's moving, they're the ones who are doing it. It's not you or I. The only time you or I move the market is when there's an overabundance of market orders coming into the market from passive technical traders. Because a market order does what? Okay? If the last price is 10, we've got 9, we've got 11. Okay, what's the market? The last price is 10. If I want to buy, the market's actually 11, isn't it? That's the market, because that's where the offers are. The offers are at 11, so that's where I'm going to get filled. I'm going to get filled at 11. Well, if there's so many market buy orders coming into the market, and all the offers are taken out at 11, then that means the next price up where there's offers are 12, and that's where I'm going to get filled. And if there's so many more that got in before me, and this is real, it's really an overabundance of buy orders in relationship to the number of offers that exist, then I might get filled at 13, because that's the market. So that's the difference. You've got an overabundance of passive technical orders coming into the market that will drive it up, or you've got dynamic traders who are doing it purposefully. And when they're doing it purposefully, I guarantee you they got a good reason for it. They know what they're doing. I'm not saying it always works, but they know what they're doing. And it doesn't mean that you can't take advantage of it. It doesn't mean that you can't make a consistent income, even a really good consistent income with your technical methodologies. You don't even have to understand all these subtle dynamics of market or price movement to be able to take advantage of it. All you've got to do is be able to trade your edge and follow your plan. I just want you to understand that when you understand what's going on, you will be able to trade your plan, because you won't be putting so much emphasis on things that don't have any relevance. Like expecting this next trade to work just because you got a signal.
Is this what drives the price up typically early in the morning, like when the market opens, some popular stock, all the orders come in or it goes down, and is that what creates this gap? Or
well, I can't tell you when you say that's what happens, let's put it this way.
Is it a log jam?
You can always break it down to one fundamental reason. The only reason that really there is. There's an imbalance between buyers and sellers. Price movement is always the result of an imbalance. Because when there's balance, there's no movement.
Right.
It's that simple.
Right.
If there's balance, there's no movement. Prices do not move when there's balance. There has to be an imbalance for people to bid it up or offer it lower. And if people aren't actually bidding it up in this example, we don't see the reason why I can't answer you exactly is because I don't know if it's actually being bid up purposefully by somebody, or it's because there's an overabundance of buy orders in relationship to the amount of offers. That's what I don't know. Okay? The patterns basically measure the collective mind of the market. In other words, here, and I should have really emphasized this word, collective mind of the market. Not the individual minds, the collective mind. Meaning all of the actions, all of the beliefs, all of the agendas, all of the objectives are built into that next incremental price change from 11 to 12 or from 12 to 13. It's all there. And the only thing that mathematical formulas can do is actually measure that, measure the patterns that result from that information. It isn't getting the information of the guy who actually bid the market up by taking out all the offers because he's got some specific agenda about what he wants to do with where he wants to see the prices go, because he's doing something that has nothing to do with any of this, meaning your technical methodology or anybody else's. He might be putting on a huge hedge position based on some contract that he has to deliver something 3 months from now. So collective mind of the market, indicating when there is a higher probability of one thing happening over another, represented as an edge. So because the patterns show up in every time frame, technical analysis turns the market into an unending stream of opportunities to enrich ourselves. These patterns that the mathematical formulas identify show up in every time frame, from the smallest to the largest. And as a result, if we learn how to think about these patterns or edges appropriately, it will actually turn the market into an unending stream to enrich ourselves. But not on a trade-by-trade basis. But rather as a percentage over a series of trades. This is big, guys. This is it right here. This is the holy grail of technical analysis right here, right now. Your technical indicators will turn the market into an unending stream of opportunity to enrich yourself, but not on a trade-by-trade basis. But rather as a percentage over a series of trades. That means you have to learn how to think in probabilities. You may understand the concept of probabilities. It doesn't mean that you can think that way. I've worked with traders. In fact, one guy came to one of my workshops many years ago, a hedge fund manager, reasonably successful, let's say reasonably because he made, 10 to 18% a year. But his indicators, if he had followed them the way they were planned to be followed, he could have made anywhere from 60 to 70% a year. A little frustrated, came to a workshop, and then, some consultations afterwards. In one particular situation where he said, he put in a trade he'd been watching for months, finally got to his price level. He put the trade on, then put a stop in the market, and the market started approaching a stop, and, he got out of the trade early. The market didn't even hit a stop. He got out of the trade early, and then it just just fell to pieces because he was short. And in his direction, he wasn't in the trade. And he would have been someone who would have said that he understood the nature of probabilities because he majored in it in college. But he did not do the sufficient amount of work to train his mind to think in probabilities at a functional level. There's a huge difference. You can't take it for granted that because you understand the nature of percentages that you can think that way at a functional level. It would be, like you can do, I'll do the analogy to technical analysis to flipping a coin, okay? That if you take an evenly weighted coin and flip it 1,000 times, you've got a large sample size there, right? The pattern that will emerge with each 1,000 flip sample size is a relatively even distribution between heads and tails. Maybe not quite 50-50, but let's say 49.2 and, 49.8 or something, whatever. There might be a little bit of more variance there. But in any case, that will be a pattern. See, that's a pattern. Because it'll happen every single time you flip the coin 1,000 times. But within that 1,000 flip sample size, is there any way, since you're going to get an even distribution between heads and tails, is there any way that you can know for sure which individual flip is going to be heads and which individual flip is going to be tails? No. You could get 10 flips of heads in a row and be absolutely positive the next one's going to be tails. And it could come up heads again. And even though you can have all these streaks of heads and tails, in the end, they're still going to come up 50-50. This is exactly the way technical analysis works. Exactly. When you consider the diversity of the market, with all the different players and all the different agendas from people all over the world, trying to predict what will happen next would be almost equivalent to sitting in front of a slot machine and coming up with some rational reason why you think that the pattern that you're looking for is going to come up on the next push of the button. It wouldn't make a lot of sense, would it? But the reason why we get fooled as traders, and we think of it in not this probabilistic way, is because when we put on a trade, we put on a trade for a reason. See, reasons are important in our lives. Reasons are important. We put on a trade for a reason. And see, the problem is that when the trade works, we just naturally think our reason was right. What I'm trying to do here is help you disconnect any reason that you put on a trade with the reason why it actually moved. Because like I said before, there's almost never a relationship. There's almost never a correlation. And so the next time that reason seems to appear in the market, we're gonna do the same thing, thinking we'll get the same result. And then when we don't, we feel betrayed. And then the next time the reason comes up, we're going to be a little hesitant. And we might not put it on at all. We'll try to find additional reasons why this trade will work. When the reality is there isn't any reason you're going to be able to come up with that's going to assure you of anything. Unless the reason you're coming up with is the people who are actually going to bid the market up or offer it lower. And they tell you what they're going to do and why. Ultimately, there's only one reason why prices move. And what would that reason be? Come on.
Imbalance.
Yeah, an imbalance in conviction. That's the only, and what technical analysis does is it finds patterns in that imbalance, okay? Technical analysis finds patterns in the imbalance. Where there's momentum in a direction. It's still not going to tell you what's going to happen next. Technical analysis doesn't, nor can it get into the minds of any particular individual trader who has both the financial and psychological resources to either move prices or defend certain price levels. And traders will defend price levels, by the way. There are dynamic traders who will actually defend a price. Is it reasonable to expect the fixed criteria that make up a mathematical formula to stay consistent with a dynamic event that's in perpetual motion on a trade-by-trade basis? What's the answer to that? Well, what is the answer?
No.
Come on. No! No, it is not reasonable. No, it is not. Especially where that motion is being caused by traders all around the world with differing beliefs, objectives, and agendas. There is no way of determining the intentions of all these traders, yet the typical passive trader trades their methodology as if they are being told what those intentions are. The professionals do not. You guys get that? The typical passive technical trader trades their methodology as if they are being told what their intentions are, whereas the professional does not. And why doesn't the professional? Because the professional understands the underlying dynamics of price movement and that anybody could come into the market at any time to do anything. There was another floor trader that I worked with who executed, traded his own account in the soybean market, but also executed the orders for at the time, one of the biggest soybean producers in the world. There was an Italian firm that actually tried the corner of the soybean market, got thrown off the board of trade. But before that happened, there was many days where, he would call, be in touch with the head traders at the home office, and they're plotting out their strategy. He told me one day, it's like the whole strategy for that day from the home office traders, the whole strategy was to spank the locals at the Chicago Board of Trade. That was their only purpose that day. They were going to suck the locals into a trade, and they were going to try to wipe them out. So he said, we're going to spank the locals today. Now, your mathematical pattern, okay, you happen to get a buy signal, ends up to be a big winning trade. You think it's because a couple of lines crossed, no matter what it is, whether it's stochastics or wise trade or whatever, it doesn't really matter. It had absolutely nothing to do with the reality of why the prices moved.
If you would like to learn more about the price patterns, about the charts, about how to be profitable in trading stocks and options, visit marketcrash.money. Click right here, how to profit, and find out the 5 core fundamentals that helped me turn 12,000 to 466,000 in less than 7 hours trading options from my laptop. Discover the power of accelerations of trading options. Are you completely fed up with ordinary results? Then definitely visit marketcrash.money. Hit this big green button and take action now. Get the answers that you've been looking for. Specifically, in this 1.5 hour course video, not only do I explain and specifically give you details on how I turned 12K into 466 in a very short amount of time, but I reveal a ton of secrets, specifically which are the best stocks for trading options, the top 3 chart patterns for huge returns, the key to locking the huge gains, how to trade the reaction of the market to the news rather than news themselves. I help you discover the secret behind timing. Can you imagine if you could only trade on days where you have a 70-80% probability of getting your trades correct and avoid the days whether the probability is entirely uncertain? And more secrets like discovering the difference between the trend and TRO and what it could mean to your trading results. Again, visit marketcrash.money, hit the big green button, and make your 2018 the most profitable year ever.